Welcome to the Deep Dive. Today, we are tackling a really interesting paradox in personal finance. We're talking about the successful, the high-earning person who insists on managing their own money. And we're going to dig into the claim that for a lot of smart people, doing that is actually the most expensive time sink they have. And this isn't about, basic 401k stuff. We are diving deep into sources that try to put a real number on the long-term financial cost of DIY investing. Our mission today is to really understand the value of professional fiduciary oversight and, I guess, where the money gets lost when you try to go it alone.
And we should probably get to the core financial hit right away because the data we looked at is, well, it's pretty stark. Research, including a lot of work from Morningstar, consistently shows that the typical DIY investor underperforms the very funds they are invested in.
Wait, underperforms the funds they're in. How does that?
By nearly 1% a year.
Okay, let's unpack that. Because 1%, it sounds so small. If you tell someone they're getting a 6% return instead of 7%, they might just shrug.
They might. But in the world of compounding, that small gap it's deadly.
So what's the real world cost? What does that tiny gap actually cost over, say, a few decades?
It's absolutely devastating. This is where it stops being about percentages and starts being about real wealth. Over a typical 30-year horizon, that difference between earning, let's say, 7.05% versus only 6.1%, it all comes down to those behavioral mistakes. That gap could cost you approximately $457,000 in lost wealth.
Wow. $500,000.
Yeah.
And not because the market did something weird, but because of your own preventable mistakes.
Precisely. And for more affluent individuals, people managing high net worth portfolios, that 1% error, it just grows exponentially. It can turn into millions fast. So the real question for a high earner isn't, can I learn to place a trade?
Does it make any financial sense for me to do this?
Exactly. Is the opportunity cost of your time and energy worth it compared to just handing it to specialists whose entire job is to avoid that $500,000 mistake?
That sets the stage perfectly. So our sources lay out 7 big mistakes, and we have to start where the most damage is done, the emotional stuff. This is the category that gets that label, the $457,000 mistake.
Yeah, this is pure human nature at war with compound interest. It's really just 2 things. Fear and greed, they're the drivers. When the market drops, DIY investors, they panic. They sell their assets at a loss because they can't handle the volatility.
And the flip side is greed.
The flip side is greed. When markets are soaring, after maybe a year or 2 of amazing performance, the headlines are all glowing. That's when they jump in. They pour money into the things that have already spiked. This classic pattern of chasing performance, buying high, selling low, is the engine that drives that huge gap in returns.
The perfect example we saw was March 2020. The market sold off so hard, and so many DIY investors just liquidated right at the bottom. They locked in massive losses. But the people who stayed disciplined, or even better, rebalanced into the dip, they captured a recovery where the S&P 500 gained over 100% from those lows. Missing that initial bounce is just so incredibly costly.
It's a phenomenal point, and it really highlights the power of just doing nothing. What's fascinating is this well-known finding from a Fidelity study. They looked at their accounts and found that their best performing investors, they all had one thing in common.
Which was?
They literally forgot they had an account. They never checked their balances.
That's amazing. So the best way to win the investing game is to forget you even bought a ticket. That just says everything about the danger of constantly tinkering when you have a good strategy in place.
It does. And that impulse to do something leads to the biggest challenge of all, trying to time the market. We all know it's basically impossible, even for the pros, but the data we reviewed really hammers this point home.
Yeah, I think we all know we shouldn't try it, but the penalty for failing is it's shockingly high.
It's brutal. Because market growth is so concentrated, if you hold your money on the sidelines, waiting for that perfect moment to get in, you almost always miss the most important days. And the specific data is for the 20 years from 2000 to 2019, if you invested $10,000 and just left it alone, you'd have earned about 6.06% a year.
Okay, pretty good.
Now, if you missed just the 10 best market days in that entire 20-year period, your annual return drops to only 2.44%.
It gets cut by more than half for missing 10 days out of 20 years.
More than half. And what if you missed the 20 best days?
I'm guessing it's not good.
Your returns become negative. You actually lost money. It just proves that time in the market is what matters, not timing the market. The cost of just a few bad decisions is massive.
Okay, so that covers the emotional side. Let's shift to the more strategic and technical mistakes. This is where successful people often think their expertise in one area will just translate. And first up is overconfidence bias. So, wait, you're telling me that a brilliant surgeon or a CEO running a huge company, someone who handles incredible complexity, is somehow worse at managing their own money? That just feels totally counterintuitive.
It is counterintuitive, but the sources are pretty clear on this. Being an expert in one field doesn't make you an expert in global finance. Building a business takes one skill set. Investing requires, a deep knowledge of asset correlation, economic cycle, risk management frameworks. It's a different discipline.
And that overconfidence leads right into the next mistake.
It feeds it directly. Inadequate diversification, or what we often call concentration risk. DIY investors do this all the time. They get a hunch, they trust a few names they know, and they build these really poorly balanced portfolios. It's the classic all-in bet, all crypto or all tech stocks, or, and this is a very common one, loading up on their own company stock.
Which feels safe, right?
Yeah.
Because you know the company, but you're linking your salary and your net worth to one single entity.
Exactly. And true diversification is so much more than just owning 10 different stocks. It means geographic diversification, different asset classes, stocks, bonds, real estate, alternatives, and diversifying across time through systematic investing. Most individuals just don't have the tools like correlation matrices to see how all their assets will actually behave together when things get rocky.
Okay, this next one feels like the most important for anyone with significant assets. It's where money just quietly leaks away. Tax inefficiencies.
This is the hidden financial drain, and it's an area where professional management can genuinely add measurable returns. The data suggests that disciplined tax strategies can add 1 to 2% a year to your after-tax returns.
So think about that. If your emotional mistakes are already costing you 1%, and you're leaving another 1 to 2% on the table with taxes.
You're losing 2 to 3% a year right off the top, just by doing it yourself.
So how do they get that 1 to 2% gain? Let's start with something called tax loss harvesting.
Right. It's basically the systematic practice of selling investments at a loss in your taxable account, specifically to offset the capital gains you've realized somewhere else. It lowers your overall tax bill without really changing your portfolio structure.
And then there's this crucial concept of asset location. Can you explain that simply? That sounds pretty technical.
It's just about being smart about where you hold your assets. You want to put the things that generate the most taxable income, like high dividend stocks, inside tax-protected accounts, like your IRA. And then you keep the more tax-efficient things, like growth stocks, in your regular brokerage account. It's a simple idea, but it's so powerful and so often overlooked.
And then on top of that, you have sophisticated charitable giving strategies, integration with estate planning. It's a level of coordination that's it's almost impossible for one person to manage effectively while also having a demanding career and a family.
It's a full-time job. It requires year-round coordination with accountants and attorneys.
Yeah.
It is not a once-a-year thing you do at tax time.
Speaking of ongoing work, let's talk about the set it and forget it trap, which the sources call the drift problem.
Right. Even if you start with a perfect plan, say a 60-40 stock-to-bond portfolio, if you don't rebalance, the market's movements will push you away from your goal.
So if stocks have a great couple of years, that 60-40 mix could easily become 75% stocks and only 25% bonds without you even noticing.
Exactly. And now you've unintentionally taken on a lot more risk, often right when the market might be peaking and is most vulnerable. A professional approach involves systematic rebalancing to make sure your portfolio always stays at the risk level you actually chose.
And finally, there's just a simple barrier. The DIY investor often can't even get access to the same opportunities.
That's a huge one. Individual investors just don't have the capital or the accreditation for entire asset classes. We're talking about things like private equity and venture capital, which have historically offered great risk-adjusted returns. And it also includes institutional-grade funds with lower fees or sophisticated alternatives like certain hedge funds or real estate deals. There's kind of a velvet rope that the average investor just can't get past.
So let's pull this all together. If the DIY route is filled with these costs, from the $500,000 emotional mistake to the 1-2% annual tax leak, what's the real value of getting professional advice, especially from a fiduciary?
That word fiduciary is everything. A fiduciary is legally and ethically required to put your interests first. It means they're not just selling you a product to get a commission. It removes that fundamental conflict of interest.
And once you have that trust, the value comes in those 4 pillars that directly fight all the mistakes we just talked about.
Yeah.
Pillar 1 being behavioral coaching.
And this is arguably the most valuable thing they do. The advisor is that objective, calm voice in the storm. When markets are crashing, They're the ones who stop you from making that $457,000 panic sale. They keep you focused on the long term.
Pillar 2 is that comprehensive tax strategy. This is the integration piece. It's not just about investments, it's coordinating everything, your estate plan, your business deductions, to lower your lifetime tax bill. Like we said, that can add 1 to 2% a year.
Pillar 3 is superior risk management. They're looking at your whole financial picture, not just your stocks and bonds. They're looking at your concentrated stock, your real estate, business liabilities, insurance gaps. They find risks you didn't even know you had.
And the last one, pillar 4, is that access to opportunities, getting you past the velvet rope into those institutional investments that can provide real diversification.
So the ultimate decision for our listener really has to come down to opportunity cost. If doing all this right, the research, the tax harvesting, the rebalancing takes you, say, 10 or 20 hours a month, you have to ask, could I earn more than the advisor's fee in that time by just focusing on my career?
That's the real economic calculation. Your time is your most valuable asset. And for high net worth families, the stakes are so much higher. A mistake that costs one person thousands can cost an affluent family millions. Professional oversight just becomes essential. Let's summarize the key takeaways then. The shocking numbers are really the foundation here. That potential $457,000 lifetime cost of just emotional bias. And that very real 1 to 2% that's added every year just through smart tax planning and discipline.
The truly successful investors we examined, they recognize that their time and their expertise were just better used in their own field. They let the professionals handle the complex, ongoing work of managing a portfolio. It's really just a matter of specialization.
So we'll leave you with this final, provocative thought, which comes straight from our sources today. The question isn't whether you can manage your own investments. It's whether you should, given the true, compounded, and often hidden cost of going it alone.